Good evening. This is Ken Long from Tortoise Capital Management on August 18th, 2009 with a case study in transitioning from a successful intraday trade with intraday levels of risk to an overnight trade while maintaining your sanity in your risk management. So here's the situation that we had today on the 18th. The previous day, the 17th of August, the market had a significant volatile sell-off. It gapped down and failed all day. That triggered a number of mechanical systems that play for a rebound and a reversion to the mean in a bull market. When we saw that move happening broadly in all market sectors, we ended up with a number of successful trades. One of them was Alcoa. Alcoa had closed the previous day low about 1240 and then gapped up around 1260, surged, pulled back, found support by the opening range five-minute candle. The market was surging. We ended up buying here at 1270 with a 10-cent trailing stop, which we had in force all day because the market was pretty strong. And so 40 minutes prior to the close, here's the situation that we have. We've cashed a number of other trades, and we're deciding whether or not we want Alcoa to be an overnight trade. It was the strongest closing trade of any position we had, so we cashed the other ones and are now going to make a decision about Alcoa. So 1 hour before the close, we have 2R in hand in Alcoa. And what that means is that we had risked $250, and with an initial risk per share of 10 cents, that means we can have a 2,500 share position size. And we've made 20 cents a share. We're holding it right at $12.90. We bought it $12.70. So we're holding $500 open profit on an initial risk of $250. Now we're trying to figure out what an appropriate position size is for the overnight hold based off of measures of volatility in the overnight trade. On the intraday trade, 10 cents is reasonable for us in Alcoa because we can monitor the position while the market is open. But in the overnight trade, where we have less control over news, 10 cents is too close. So here's some statistics that we examined from our gap stat report. Looking at Alcoa, in the last 200 days, the maximum favorable gap in Alcoa has been a little over 11%. The maximum adverse gap in the last 200 days was 11.6% against it. The standard deviation of those 200 gaps is 7.75%. So what that means is if Alcoa were to gap down 7.5% against us tomorrow, that would be a normal size gap. It would not be out of the ordinary at all. The average true range of Alcoa is 5.3%, meaning that on a given day, Alcoa will trade in a 5% daily band. So it's relatively volatile during the day. So it's pretty clear that with Alcoa trading at $13, 8% of $13 is a little over $1 per share. So 10 cents is certainly not wide enough to have for overnight risk. So what we have is ATR percentage of 5.3, maximum normal adverse gap 7.75%. In the last 200 days, it's gapped against us 11.6%. And in fact, as recently as yesterday, there had been an adverse 9% gap. So now the question is, how do you play the close? How much risk are you going to take overnight, and how many shares? And then what are you going to do in the last 40 minutes of the opening? How shall you play that, knowing that right now you're holding 2,500 shares with $500 open profit? This is a good place for you to stop the movie and do a little back-of-the-envelope figuring. And I'll show you what we worked out in the chat room today. This was our plan. We first decided that the risk that we were going to protect ourselves against was 8%, which was that maximum normal adverse gap. And we rounded that off to $1 per share of risk, because 8% of 13 is roughly $1, give or take. What we decided was that with our core capital we had been willing to risk $250, so we were not going to risk more than $250 overnight with our core capital. Because we were holding $500 of open profit, we were willing to risk $150 of that $500. So with an overnight risk total of $400, which is $250 of core capital and $150 of markets money, we're willing to risk $400 at $1 a share overnight. So that means we're prepared to hold 400 shares overnight. And since we have 2,500 in hand, what that means is in the next 40 minutes between now and the close, we're going to look for a tactical opportunity to cash 2,100 shares at the peak of a momentum surge. And you can see in Alcoa how it gets these little peaks. What we want to do is try and time one, so in the next 40 minutes, we might be able to get one. And as it turns out, we're actually able to find one at 12.94. Now, in the chat room, we worked through an additional contingency, and that was, what if the market puts in a really strong finish in the last 20 minutes, and the S&P goes up 0.5%, and Alcoa goes up an additional 25 cents? That could happen. Our contingency was that because that 25 cents on 2,500 shares would represent another $525 of open profit, we'd go ahead and risk another 100 of that profit. So we, instead of holding 400 overnight, we'd hold 500 overnight, and then we'd be grateful to cash 2,000 shares with the additional 25 cents in that contingency. The important point there is we were not going to let a last-minute surge tempt us into holding too much overnight in a very volatile stock in a fragile market. So that was our plan. Unless something extraordinary happened to the upside, we were going to cash 2,100 shares before the close, hold 400 overnight with $400 of open risk based off our core position risk and playing with 150 of the market's money. And then our contingency was, if a sudden upsize surge, we'd hold an additional 100 overnight, but bank the remainder of the profits as a gift. Now, there's 100 different ways that you could play this, and you could be as detailed or sophisticated as you want, taking a look at the market position and in short-term overbought, oversold. This was the decision we made in Alcoa, and what it does is normalize the amount of risk for each trade that we propose to hold overnight, so that I'm not more exposed overnight when I have less control over exiting the market than I am during the day. So that's our case study in Alcoa. Thanks for your attention.